Yes, now we are just practicing our question number 5. Question number 5 is asking return and risk. So we were first doing the return of risk of ABC. We were started doing the probability return. Now this probability return we got return is what? 12.55. Now you want to find out risk. So we know this question is what? With the probability. With the probability in a root of sigma PD square. So PD square is we have. So we have to get what? Root of square root of 168. This number 167.75. That is. So now if you go for square root, you will get the answer called what? 12.95. See, very important point is higher the return, better the option. Higher the return, better the option. Lower the risk, better the option. Risk is low is best. Return is higher is best. So when you want to do sometime, we want to do the comment also. Next, we want to do for I'm not doing the risky again, but we want to do for the third part. What is the third part? Second part of this question. Same thing. You have to find out the portfolio. You want to find out the portfolio. How can you do this portfolio? Friends, here you don't want to go for portfolio equation. Here you want to find the proportion equal. So we have the data. So what is the shortcut method? You can just directly, we don't want to go for portfolio formula and all. Here we don't want to go for portfolio. Portfolio formula we want to apply if question doesn't give any data. Directly risk is given. Here the data is there. So what you can do now, you can just go for a column called what? Return of a portfolio. What is the return of a portfolio? See, first one is 12, second one is what? 16. Weight is given 0.5 into 0.5. You know return of portfolio formula. A weight of security into return of security summation. So you have to do 12. 12 into 0.5 plus 16 into 0.5. So this is another method you can find out the risk of a portfolio. Same way you can do for remaining item. Next will come 12. Next will be minus 7 plus 28. Next, if I'm not wrong, 13. Correct? So this is what return of portfolio. Now our normal step only. You can go for what? Expected return of portfolio. So this is the another method you can find out the portfolio. When we want to approach the formula, that I will tell you on the next day. That is the next second model question. So we will find out the return of portfolio. Now, if you want to get the return of the risk of portfolio, same thing, deviation. How can you do return minus R? This is how you can. Now you can able to go for see deviation is there. You have to take the summation. Now you have to go for risk of portfolio consisting of equal weight that you can write equal weight. What will come? Square root of 6.69. See, that's all. This is how you have to get it. Are you clear? Yes or no, friends? This is how we can able to do it very fast. Next, they were asking what is the proportion of each stock to make a minimum risk of portfolio. For that, you have to approach our formula. We have two security, weight of A, B, so weight of A, variance of B, variance of B minus covariance of AB divided by variance of B plus variance of A minus 2 covariance AB. Here the problem is what? We got the variance. Variance is nothing but standard deviation square only. But the problem is what? We don't have the covariance. That covariance you have to find out. First, you have to identify with the probability or without probability. Come on, friends, with the probability. So we have to do for the next security. That is security. One more we have to take. Am I going fast? Are you able to understand, friends? All of you able to recall, friends? Yes. So what is the return of XYZ? What is the return of XYZ? We have 16, 10, 28 minus 2. We can go for expected return. See, expected return. Actually, we thought of we don't do it, but for the second part we require anyway. See, there is a one more shortcut for getting this return. You go 12.55, you go 12.1, equal weight only. So this 12.33 you will get in another way. 12.55 into 0.5 plus 12.1 this into 0.5. If I do enter, I will get the same 3. Here we have 325. Yes or no? This if you get the return of two security portfolio, you can get it. You can, but we can't do that in this case because they are asking risk also. If they are asking only return of a portfolio, don't do this bigger table. You can get in a shortcut method. This you got it, this you got it. They are told what equal. But here why don't you why we don't done so far? Because they are asking risk also. So anyway, risk you have to get this data. That is why. Okay. Now you notice over deviation of x r minus r bar. So we are doing an experience for covariance also. Covariance also we are practicing in this question. So we done this. So we got. Now we can go for. Can you recall the covariance formula? Covariance formula I will recall for you. Summation of with the probability only. Summation of probability into deviation of x into deviation of y, whatever it is. So here I am doing everything into one line. Probability into deviation of a into deviation of x. So probability is the same. Deviation of x is this. Deviation of a we have here already. Since I am using Excel, I can take it directly. Are you able to recall this? Yes. So if I go through this, I am getting the data properly here, which is 509. This is what my covariance. If I want to get the correlation, correlation what is the formula? Covariance by standard deviation. So here in this question, they are not asking correlation, but if you want, we can do that correlation also. How? It's 508 divided by standard deviation of first security into standard deviation of the second security. The question is not asking the correlation, but we did the correlation for this, which is no. There it is. This into this. Once again, here probability we are not done. This is one small correction in this risk calculation. We got probability, we got return, so we got deviation r minus r bar. Not that reason. Okay, okay. Why this is different? Because this is portfolio. We should get risk of what? We should get risk of. Can you just tell me? You might have already written the risk. What is the risk of XYZ? You might have already computed. What is the risk of XYZ? 11.27. The reason because why I put this error because we know correlation coefficient will come within +1 to -1, but we are getting some 33. Why it is wrong? Because I have taken correlation standard deviation of x, but for y purpose I wrongly taken what portfolio because we don't find out the security. Now you just see this correlation. What is the correlation coefficient formula? covariance divided by standard deviation of security into standard deviation of second security, which is 11.27. This 11.27 we were not dead because time saving purpose we thought we'll do for one security. So that is the reason. Now, just for understanding for you the correlation concept also we are doing. So we are getting once again here what happened it is when I'm taking the Excel, I will just this is how wherever if you make mistake, that is also there's a shortcut for you to get whether you get the wrong or not if you're correcting concept. Probability into deviation of X I have taken correctly. For deviation of A, I should take this column, but I have taken wrongly this. So this is how. That is why in the beginning of the portfolio chapter I told one area if you do one mistake everywhere you will get a mistake. Are you understood? So that is why you have to do proper practice. So I'm just putting enter. Now I am just taking the scroll down. This variance will change 144. See, now I am getting this answer correctly. What I am getting 0.988. Is it coming within +1 to -1? Yes. The point is what? It's a offsetting return. இது இங்க பார்த்தாலே தெரியும். இங்க பாருங்களா? Here minusனா இங்க plus. இங்க plusனா இங்க minus. That is why we are getting an offsetting return here minus 0.98. Are you able to understand, my dear friends? So this correlation coefficient they are not asking at all. Correlation coefficient they are not asking at all, but we are doing that practice also in this question for a better understanding. Now we will go for this area. Weight of A is equal to variance of B minus covariance AB. Variance. So how you will approach, my dear friends? Variance of B. Variance of B means just now only we did this variance. Okay. This variance also GX square. This is what variance. It's total. Before taking square root, that is what variance. See, this is the variance. What is the variance, friends? 126.99. Yes or no? 126.99. So we are doing that. 126. This is the homework question we did in the class. We did in the class. Yes. 126.99 minus covariance. What is the covariance? See, here we getting covariance of minus 144. Minus will become what? Plus. Minus will become what? Plus. So you will get what? Plus 144.26. Then again the step starts. Variance of B. What is the variance of B? Now only we find out 126.99. 126.99 plus variance of A 167.75. Now minus only, but you have to multiply with minus. Minus will become what? Plus. So 2 into 144, which will come 288.52. If you do this, what you will get the weight of A, friends? It will be 126.99 plus 144.26 divided by 126.99 plus 167.75 plus 288.52. You will get 0.47. Or you can take decimal if you take 0.46. Now, what is the weight of B? Balance. Weight of B will be 1 minus. Hope all of you are clear. Hope all of you are clear. So this is a question where we were applied which all the concept, how to compute risk with the probability, then how to compute the risk of a security, how to compute risk of a portfolio when this kind of method. This is a method one. This we have not written any formula. It is a formula we don't return at all. Then we are also find out correlation coefficient. We were find out covariance. We were also discuss that optimum value. That is why one question you are calculating everything. You might have been written when they have selected wrong column. My question get what? Error. We know that correlation coefficient plus or minus it should be, so we identified it's a error, but sometimes it will not have work out. Covariance if I taken wrong, I can't identify because of covariance if I taken wrong, it will be plus or negative. Any number can be. There is no clue. So don't think that always you can check whether you are getting wrong or so. You have to practice, then you can be able to eliminate the errors maximum. Yes or no? Shall I proceed next? Shall I proceed? So if you are time permit, you can also parallelly practice also, or it is your wish. Okay. But my point is what? To make you understand the concept how to approach. Now we'll go for next one question. Next question, case 2 model question. What we will do now? Question have all the data. We will just go for it. How? This question number 9. What is the point, my dear friends? European has been specifically formed to undertake two investment opportunities, risk and return as given below. See, the question itself is risk and return is given. What is the difference between previous question and this question? Previous question, risk and return is not given. We only find out. This is a second model question where we will find out what? Risk and return. Here, risk and return is given in the question itself. The weight also given 80% and 20%. Then correlation is what? 1. Then they are asking return of the portfolio, risk of the portfolio. Here you have to approach the formula. You can go for table method because if you want to get table method, the full data must be there, yearly or probability data. Then you have to do for what? The formula method. Are you ready, friend? So for me, I can able to do very fast. What can we go for it? First, you can go for return of the portfolio. We are expert on return of portfolio, weight of security into return of security. So 12 into first security weight is what? 0.8 plus second security weight is what? 0.2. So what will be the answer, friends? 13.6. This is how you have to get. Next, you want to find out risk of portfolio. How can you get risk of portfolio, my dear friends? You have to go for square root of. We'll do everything directly the formula. Weight of A, which is 0.8. Weight of A is what? 0.8. You have to multiply with the risk of A. What is risk of A? 3. See here, you can give directly 3 itself. If you give 0.03, then everywhere decimal mistake will come. You can give 3 itself. Final answer you can go for what? Percentage. So 3 whole square. Next weight is 0.2. What is the risk difference? 7 whole square plus 2 into weight 0.8 into 0.2 into 3 into 7 into correlation they said what? 1. Now you can able to approach. See what is the first item total? 0.8 into 3 square. What you will get? 2.4, no, 5.76 plus 1.86 plus 1.96 plus 6.72. If you take the total, this is what method 2. Final answer. What is the final answer? 3.8%. This is how you have to find out the risk of portfolio. Method 2. Correct? Now what is happened next, my dear friends? Suppose the correlation coefficient is -1. What is the company to obtain? 0. Just now only we did it. But the problem is what? Previous question we did to minimize the risk, where covariance we find out with the formula. First formula with the probability. Here we have to do second formula. You can't go for the first formula. What is second formula? You have to go for covariance. Covariance you have to go for, that is correlation of two security into, they are given data. which is what data they give standard deviation of A into standard deviation of B. That is minus 1 into 3 into 7. You have to get minus 21. That means you have to apply different formula. Previous question you did what? That is with the raw data you are getting. Here already standard deviation is there. With the standard deviation you are getting. Correct or not? This is what we need practice. Your application will keep on changing. Are you clear, friends? Now you can apply the formula. What is the formula? Weight of A is equal to B. 7 square. Minus minus will become what? Plus 21. You will have 3 square plus 7 square plus 42. 49 plus 21 divided by 9 plus 49 plus 42. You will have, if I am not wrong, 70 by 100. You will get zero point 0.7. So weight of B will be what? 0.1. See how interesting. Are you able to get it? This is what case 2 mode. This is what? Case 2 mode for optimism. Yes or no? So this question also over. See, now what is this question number 10? We are not practicing. I'm just telling you. See here, the same data, return is given, standardization is given. There is a proportion of investment to minimize the risk. So what you have to do? You want to do the same step, covariance you have to apply. Then you have to apply this formula. That's all. This data of return is given for confusion. This data is given for what? Confusion. You want to apply only this 18 and 15. Just now we applied. Are you able to clear? Yes. Here also, this is also same point. This is also one of the previous year question. They were given 5 situation. Risk is 3 and 9. Just now in the question we did what? 3 and 7 with a correlation of minus 7. Here what? Situation 1. You have to assume correlation coefficient is what? Minus 1. You have to go for minus 0.3, 0, 0.6. Like that you have to change in each situation. Each situation, covariance is not given. Everywhere they are asking what? What is the proportion for minimize the risk? So you have to approach our formula called the weight of B square, that is variance of B square minus covariance AB divided by variance of A plus variance of B minus 2 covariance AB. So how you have to approach? Covariance is not given, they given only what? Correlation. For each case you have to find out what? Covariance. How you get covariance? Correlation into standard deviation of two security you have to multiply. When you do this question, the last method is 0.6. If I am not wrong, you will get greater than 1. You get greater than 1. You can check your answer. So if you get greater than 1, what is the meaning, friends? You can't diversify. You can't diversify. You can't diversify. That is how the question. Are you clear? So we are able to. These are all same points. See, this question number 13. If you take your notebook, see the first two parts. இப்போ நம்ம டிஸ்கஸ் பண்ண அதே மெத்தட் தான். A and B இப்போ நம்ம டிஸ்கஸ் பண்ண அதே மெத்தட் தான். ஆனா C ஒரு reverse calculation. Can you just take your notebook 13? What is 13 happening, my dear friends? 13 எடுத்துட்டாரா? So hope all of you taken the 13 question. 13 question. Let's C part. A and B same thing. C part what they are asking now. If correlation coefficient is minus 1. No. This 13 same question only. What is the how the company should obtain? No, this is same model only, not 13. Let me take another one. Yes. This question number. Question number 18. What is this question number 18, friends? This only reverse calculation. See, they were telling, suppose the third part only we are solving now. Third part only we are doing now. Suppose the investor want to reduce the portfolio risk to what? 17. They want risk to what? 17. What is the correlation they have to bring it? That is risk you should get what? 17. So you might have been written this. Your final answer should be what? 17. Then you have to do what? Enter in formula. You have 30 and you have 26. What is the weight? Equal proportion. What is the proportion? Equal. So you have to go for it what? 0.5 into 30. First two part is risk and return, we know already. So 0.5 into 30 square plus 0.5 into second security, what is the risk? 26 square plus 2 into 0.5 into 0.5 into 30 into 26 into here we don't know. This is how you have to. We don't know correlation, that you have to put it as X. We don't know correlation, that you have to put it as what? X. Are you clear, my dear friends? Now you have to go for the formula 17 square is equal to. If you put 17 square in the series is equal to. If you put 17 square. So what is the first answer? 225. 2. Next one 169 plus 396. 390 correlation AB. So if you solve this, you will get correlation AB as what? Minus 0.27 for 269. Are you understood? So this is another method of what? Reverse calculation. This is another method of what? Reverse calculation. Are you clear, friends? Yes. Shall I proceed now? Good, thank you. Now, if I am proceeding now, I will go for this question number 16. See, I think question number 16 I have given as a homework for some batch. So question number 16 is a homework. What is question number 16 difference? Question number 16, you have three security. They are asking what is the risk. So you have to approach the formula of what? Three security. You have to approach the three security formula. So what is the three security formula? The same thing. You have to go for what? Root of. We have three security A, B, C. So here you have to approach three security formula. First security, this weight is what? 0.3. Standard deviation is what? 8. So you have to go 0.3 into 8 square plus. Next one 0.5 into 12 square plus 0.2 into 6 square plus. Now you have to go for 2 into. First they are giving here AB. So we'll go for AB. 2 into 0.3 into 0.5 into 8 into 12 into correlation they have given in the question 0.5. This is for only for first one. Now you have to do for next second one. What they are going next second one? AC given. The same order we will go for it. So if it is a AC, so I think in the regular class I given this as a homework. Now I am solving because I want to revise all this area for you. So what will be then here? 2 into AC, so 0.3 into 0.2 into 0.3 into 0.2 into 8 into 6 into minus 0.4 plus 2 into 0.5 into 0.2 into 12 into 6 into 7.5. This one. If you solve this, you'll get a final answer what? 8 point. This is how. 8.13. Okay. So this is how. This is the third one. That is two security. Now this what? 3. See how and all we find out the risk of portfolio. First method we revise this what? They given detailed A, B. Weight is given. So we maintain weight and accordingly we apply. Second method already risk weight is given. So we applied the formula called two security. Next we did now what? Three security. Are you able to recall now? Yes. Now we will be able to go for this. One of the previous year question 17. I'm not doing this, but what they are asking is they were given correlation coefficient as 0.16. They are asking what if 5 situations are there. Each situation what is the risk and what is the risk and return. and which is best in terms of return, which is best in terms of what? Risk. We know higher the return, better the option, lower the risk, better the option. So all funds in M, all the funds in M, no problem. What is M return 20? That will be the, what is the M risk that will be? Now 50-50. So 50-50, how you know? 20 into 0.5 plus 25 into 0.5. For risk, you have to approach our main formula. Root of weight of A into weight of A into standard deviation of A whole square plus weight of B into standard deviation of B square. I think you have that. So it's also a previous year question, relevant question. So I think you can be able to approach this. We did the same model now revised it. So this is also the same point. Are you clear? Yes. Now இது வந்து இப்ப இருக்கிற நம்ம ஃபார்மேட் வந்து ஒரு 7 மார்க் கொஸ்டின் 14 மார்க் மாதிரி கொஸ்டின் வந்தாலும் இந்த 20 மாதிரி கொஸ்டின் வரும். 20 question and consolidated question 14 mark. First we do that what is the return, then we find out the risk, then next year what is the return, then next year what is the risk, then we find out the risk of portfolio. We did this little bit last ending. So this is also good question, but if this will come, if it is a 14 mark, they want to test you. If they want to test you on a 14 mark, if they want to test you at 14 mark. Are you clear, my dear friends? Yes, same thing, not a new model, but it's a same thing. These are all direct questions. Directly we are asking correlation. These are all directly we are asking. Now, this is another previous year also came on this 23. A very good question. Very good question, 23. Are you ready, friends? Yes. 23. Yesterday, when the mutual fund revealed the following data, PQR, standard deviation, correlation of stock with market. Index is another name for what? Market. They were asking standard deviation of market is what? 18. What is the sensitivity of the stock with the market? Sensitivity of the stock with market is called beta. So beta கேட்டிருக்கு beta எப்படி approach பண்ணனும்னா full formula இங்க வராது. Beta means standard deviation of stock divided by standard deviation of market into standard deviation correlation of stock with market. You have to go for this. இது வந்து ரீசன்ட்டா ஒரு previous year question last exam கூட வந்ததுனால we'll just do it very fast. So you can do, you understand very easily. So beta of P, beta of security P எப்படி வரும்னா standard deviation is 20, standard deviation of market is 80 into correlation. எவ்வளவு correlation வருது? 0.66. அப்ப நமக்கு எவ்வளவு வரும் beta of portfolio? எவ்வளவு வரும்? 0.73. Next Q of, yes, beta of Q. 18 by 18 into correlation, which is 0.95. We'll get an answer called what? 0.9. Are you able to understand? Next beta of R. 12 by 18 by 0.75. இது ரொம்ப interesting question. The last exam வந்து எல்லாமே கேட்கல 7 marks தான் வந்து, so they ask for 3 or 4 only, but we'll discuss everything. Clear? So this is how you find out the beta. I mean, able to clear? Yes or no? Yes. What is next? Covariance among the stocks. See, there you can't approach this. Here you want to do the new formula we were discussing, because among the stock they are asking. So you have to go for covariance if you want A beta variance of market into beta of A into beta of B. You have to approach like this. Then only you can get the covariance. Covariance among the various stocks. Some friends may be thinking you can go with correlation. No. Your question they are given what? Correlation of stock with market. But they are asking now correlation among the stock. So you have to approach this formula. That is covariance, standard deviation of market into beta of A into beta of B. So if you approach this, 18 square will come into beta of A 0.73, beta of B 0.95. What is the answer, friends? AB in the sense it is called PQ. You might have already the answer will be there, friends. What is the answer? 225.6. Are you able to understand? Am I going fast? புரியுதா friends? இந்த மாதிரி questions பார்த்தா you should understand how to approach the formula. Next, if you go for covariance PQ na, P will come 0.95 PQ. PQ is over. Now PR. 0.95 P means 0.73 into 0.5. What you will get? 1126. Are you able to understand? Yes or no? Now next they are asking QR. Next they are asking what? QR. So QR what will come? 18 square into, we have again Q. Q na 0.95. R na 0.5. What you will get? This is how you will find out the covariance. Are you clear? Yes or no, friends? Are you able to follow? This is how you will find out for QR. Now we will go for risk of among consisting all stocks equally. That is only now we discussed it. The same formula will go equally. Now you can go 1 by 3. You can go for what? 1 by 3. You don't go with 0.3 because 0.3 into 0.3 you get 0.99 only. You want to get total as what? 1. So you better you go 1 by 3 into, then accordingly you can do. Then you will get the same answer. So now only we did it for 3 securities. If I am not doing, so if you approach the formula, you will get standard deviation of portfolio as what? 14.3. புரியுதா எப்படி வருது? Logic clear? Already for this, if you want to find out this, you should get correlation. You should get what? Correlation. Correlation எப்படி கிடைக்கும்? Already we have covariance. Already we have what? Covariance. So இந்த covariance வச்சு நம்ம correlation கண்டுபிடிக்க முடியும். எப்படி? So இதோட correlation எப்படி வரும்னா 225.6 is the covariance. So PQ. So P யோட standard deviation எவ்வளவு இருக்கு? 20. Q யோடது எவ்வளவு? 80. So you have to multiply 20 by 80. What is the answer, friends? This is how you have to find out correlation coefficient. Am I going fast, friends? Now, bookla they are able to recall a very standard question. So what is the answer, friends? 225.6 divided by 20 points. 0.625 or what are 62. So like this you have to find out for, because if you want to do standard deviation approach, you should get a point called what? That area. Yes or no? Are you clear? Now, next what you have to do is beta of portfolio consisting of equal weight. Beta of portfolio consisting of what? Equal weight. This is your beta. So equal weight now 1 by 3. You can take shortcut method. 0.73 plus 0.85 plus 0.5. What is the answer, friends? You have to take all the three and divide. 0.726. This is one shortcut method which I have done. Or you can do proper method. 1 by 3 into 0.73 plus 1 by 3 into 0.95 plus 1 by 3 into 0.5. That is also you can able to get, but final answer will get always what? 0.726. Yes or no, friends? Good. So this is the another method. Let's do finally total. Total means you have to do what? Variance approach. They are asking systematic risk and unsystematic risk. So systematic risk and systematic risk we know. We got beta already. What is a beta, my dear friends? 0.726. Now you have to do, I am doing the first method under variance approach. Systematic risk is equal to standard weight of market, which is 18 square into, you got the beta, what is the amount? 0.726. You have to take 0.726 square. Why you take this square, my dear friends? Because the word is called total. We are doing what? Total approach. What is the 18 square, friends? 324 into 0.726 into 0.726. What you will get? 527. So if you do this, what is the answer for systematic risk? 170 point. Now very important. If you want to do unsystematic risk, we are doing variance approach. The formula is what? Minus systematic risk. So you should find out what is this answer. We got the answer here, which is 14.394 P. So you have to take 14.39 square. What is 14.39 square, friends? Sorry, 207.07 minus 170 minus 170.74. What is the answer? 36.33. So, my dear friends, this is how you have to do what? Unsystematic risk total approach. Paka. So, very, very important. This is how you have to do what? Unsystematic risk. So, we did both the method. So, very good question. It's a recent previous year question. It's a recent previous year question. Shall I proceed, friends? Okay. So, this is a question for what? Characteristics line question. This is a question for what? Characteristics line question. So I will take little smaller question for characteristics line. We'll take later. See, this question number 29, we did the same point. Again, number changing is repeating. Now I will do that same. In this question itself, we will do characteristics line. We'll do this question itself, characteristics line 24. How you will do characteristics line, my dear friends? We have A and we have market. We know Y is equal to A plus BX. We have Y is equal to A plus BX. Characteristics line 16 syllabus regularly came for exam. 22 so far not came, but 16 syllabus it came regularly question. So period. We have 1, 2, we have up to how many periods are there? 10 periods are there. We have two column will be there. First one, it is return of A. Can anyone tell what is the return of A? 22, 20, 28, 16, 28, minus 6, 5, 6, 11. See, now we are doing another method. Tell me, my dear friends, this is year or probability is given. Year or period is given. No probability. So what is the method you do find out return here? Sigma R by S. Previous both exam probability. Here we are doing what? Period. So you have to take total divided by number of period. How many number of period, friends? 10. So you will get the number called what? 13. You will get the number called what? 13. Now you can go for, see, you have to understand, you are asking characteristic line only, no beta. But what we will do now in this question, we'll do a beta also asking. For beta, what you require, friends? Beta you require variance of market, covariance divided by variance of market. For covariance, okay, so we'll do covariance. So we have deviation of A. What is deviation of A, friends? Here, this is your R. Here, you don't want to go for two R, confusion not there. Here only one R. So this R minus this 13, this is what deviation. Here, this is the reason lot of students will get errors. See, in this method, this column, that is, if you want this G column answer, you are taking data from where? F column. But the problem is what? If you want in this question, if you have gone through here, if you want deviation, you are not taking from H column, you don't taking from G, your column from what? F column. This is what lot of students are making when you are conducting class test. Only few students are participating, but when you are conducting class test, lot of students are making mistakes here. That is, for probability, you have to take this return. What is the simple point? Return which is given in the question you have to take. R by R bar, you take question which is return which is given in the question. Actually, this is 12 only given in the question. This 2.4 is expected only. You should not take that. I have already highlighted the reason it happened mistake because in period method, one next column you take, but probability column you take what? Next column. Since I am using Excel, for me just to scroll down. Here they are not asking anything about other than anything. So we can end with this. See what we will do now. We will do in this question systematic risk also. We will do in this question. So we learn everything here itself also because there are questions in this that they will ask what? This is systematic risk and unsystematic risk. They will ask you systematic and But I think we did in the class also. Am I going fast, friends? No. If you want to do systematic risk, you should get a standard deviation of stock also. So we'll do the standard deviation of stock also. Deviation of A square. What is deviation of A square? See, now we are doing stock risk, risk of stock on the base of year. We discussed right now one method called a risk of stock on the base of probability. Now we are doing on the base of what? Year. Here what you do? No, there is nothing called a PD square. Here D square by year. So you have to take the sum total. Then you have to divide by what? N. What is your NA? 10. So now you can get the standard deviation of A will be square root of only what? 91.6. This is how. That is, you don't have nothing to multiply with what? Probability. This is what? No, this is return of A. This is A. This is market. Okay. My friend A is given a column for market only. Anyway, no problem. This is return of market only. So anyway, don't worry. He know that we require variance of market. So he given that we can just exclude him. So this is market. Anyway, we require this variance. So now we'll go for return of A. What is A? Can anyone tell, my dear friends? A data 18, 20, 24, 26, 18 minus 5. Yes. 17, 17, 9, 17, 9, 19, minus 7, 20. The same thing. Here also what you have to do now, your return will be sum total divided by 10. So here what you find out is return of market is 13%. Return of stock is what? 15%. Now you can go for deviation of stock. What is deviation of stock? R minus R bar. The same thing. So we can able to. Here we are doing without a probability. Now deviation of stock square. You have to take the sum total. This is what? Variance. This is what? Variance. Now you can go for each data. Are you ready, friends? First we will go for beta of security. Beta of security, here we can go for shortcut method, where covariance of stock divided by variance of market. So covariance, I will do one column, deviation of A into deviation of market, deviation of market, deviation of A. So this is the column. We have to take total divided by N. So you will get 42.5. So covariance is 42.5 divided by, you get variance of market. Variance of market, we got already 91.6. If you do this, 42.5 divided by 91.6, you will get what? 0.464. Small decimal correction may be there based on the numbers you round off. Since I am doing Excel, I get the correct answer. I am going fast. Are you able to get it? So beta, they are asking first, we got it. In the question, they were asking first beta, we got it. Now we have to go for characteristics line. We know characteristics line formula. What is the characteristics line formula? Y is equal to A plus BS. What is this Y? Standard deviation of stock, which is we have already found out 15. What is A? We don't know. We have to find out. What is the B? B we have find out 0.464. X is market, which is 13. Now you have to apply. You will get A called a 15 minus 13 into 0.464. What you will get? 5.98. So you'll get A factor as what? 9.02. Now, how you have to return this characteristics line is, you have to return this Y is equal to 9.06 into, what is the beta? 0.464B. This is the characteristics line. If they ask only characteristics line, this is the answer you have to return. This is the answer you have to return. So keep on your beta changing, your return also will change. A is what? Alpha constant factor in this case. Are you clear, friends? Am I clear? Hope all of you are clear. Some friends are little fast, so they are giving me the answer little fast. Some friends are little slow, so they may be how to recall it. That is why I'm just giving some little more time for you to recall. A standard question. Shall we proceed the third part or little bit wait? Okay. Any doubt, my dear friend? Okay. We'll proceed. Okay, friends. Yes. Now they are asking systematic. We told one question everything. Systematic and unsystematic risk. We know standard deviation of market. What is standard deviation of market? We do standard deviation approach. Already we did one variance approach. Now we'll do one standard deviation approach. So we'll go standard deviation of market. We know what is the variance of market. This is what variance of market. If I take the square, this is what. So we'll go for the square root. The standard deviation of market is what? 9.571. Now we can go for beta formula. B systematic risk is equal to, what is the formula? Standard deviation of market 9.571 into beta of stock. Beta is 0.464. What is systematic risk, friends? So in this question we are not asking, but we are learning everything in one question. 4.44. Now we will go for unsystematic risk. What is unsystematic risk? Reverse way. What is unsystematic risk? Reverse way. What is the standard deviation? So standard deviation of stock. Standard deviation of stock is nothing but square root of, we have what? This one only. Correct? This one. Square root of 117 is 10.84. So what you will get? 10.84 minus 4.44. What will be the answer? 6.39 or 40. This is how you will get it. Are you clear? So if you want to get unsystematic risk, first you should understand you have to find out what this 10.84 you have to find. That is why we did this column additionally. Are you clear? So one question, all the consolidated data we are there. You will find out how to find out characteristics line, how to get standard deviation, how to find out systematic risk, how to find out unsystematic risk, everything. Yes or no? Are you able to understand? Now, this is one a standard question, a recent previous year question, a very good question. I'll show you. This are already discussed. Yes, this one. Here only we do reverse calculation 28. So you can take your notebook answer also for a little bit time saving purpose. Okay. 28 is a very good question. You can also, since this came recently one previous year question, I don't know if it will come again, but it's a very good question only. Shall I start, my dear friends? Here come the reverse calculation. Here come the reverse calculation. Shall I start? I hope all of you have the data. Here, everywhere they are taken decimal. So we taken decimal also. Question number 28. Are you taken the answer? Yes or no? 28. Because it's more data is there, so we'll have a revision. Okay. So 28, they were given each security, A, B, C, three security only they given. Weight is given, beta is given, expected return, total variance is given. Variance method. So if the variance is given, you have to go for what? Variance approach, total variance. Total variance. Standard use of the market is what? 10. See now, very, very important. Here variance is given in decimal or in percentage. Variance is given in what? Decimal. Where market is given in decimal or percentage. So both will not work. You have to follow anything one. So here in the majority of data is given decimal. So we have to convert market also in decimal. Otherwise, you have to convert everything into percentage as you wish. In the class, we did market into decimal. So 10% we convert into what? 0.1. Now we'll go for your given the data. Covariance of AB is given. Covariance of AC given. Covariance of BC is given. First they are asking what? Portfolio beta. Portfolio beta is a very easy. How can you do portfolio beta? The weight is there, beta is there. You just multiply. 0.4 into zero point 0.2 plus 0.5 into zero point 0.5 plus 1.1 into zero point 0.3. You'll get the answer. What is the portfolio beta? You got it. 0.666. Next is residual variance of each of the three shares. Here come the main point, my dear friends. Residual variance is another name for what? Unsystematic risk. Residual variance is another name for what? Unsystematic. This is for each of the shares. So how you have to do now? Total variance is given in the question. Very, very good question. Total variance is given in the question. So step one, we find out systematic risk. Step one, we find out what? Systematic risk. For that, what you have to understand first is, here the variance is given what? Variance approach. So systematic risk also you have to find out in what? Variance approach. So you might have been done first one. Beta you taken square. Beta square you might have been done. What is a beta square? 0.4 into 0.4. So how it will be? If you want parallel also, I'll just make it. So we have A, B, and C. The beta is given in the question. What is the beta? 0.4, 0.5, 1.5. So if you want to do variance method, you have to go for what? Beta square. You want to go for what? Beta square. So I have taken the beta square. Now, once you did the beta square into variance of market, so you can go for unsystematic risk. You can go for what? Unsystematic risk. Variance of market is 0.1 into 0.1. What is the 0.1 into 0.1? 0.01. So you will get the answer called 0.016. Yes or no? Now this is for one security. This you have to take for what? All the security. Now this is variance approach. This is systematic risk. This is what? Systematic risk. Now the question is given total variance. Total variance is given in the question. What is the total variance? Which is 0.015. 0.025. 0.1. So what is the residual variance or unsystematic risk, friends? This is your total. This is your systematic. If you minus, this is what is called unsystematic. This unsystematic is under variance approach. So this part is over. Next, they are asking portfolio variance under Sharpe index model. How you did this now, my dear friends? We have two methods. One is Markov. So Sharpe index model, we have to do what? This is what we have written in your formula. You can just go through. Risk of a portfolio is equal to systematic risk plus unsystematic risk. Systematic risk plus and now they were asking portfolio variance using Sharpe index model. So portfolio variance. This is what stock only. So now you have to do what? This is under variance approach. This is under variance approach. So you have to do what? Weight of square. We have to take what? I will take weight one column, then weight of square. What is the reason we taken weight of square? Because when you do variance, everywhere you have to take the effect square. Weight is given in the question, which is 0.2, 0.5 and 0.3. But if you want to do under that method, you have to take what? Weight square. Now you can go for unsystematic risk of a portfolio. Unsystematic risk of what? Portfolio. What is unsystematic risk of portfolio? Weight into unsystematic risk. Weight into unsystematic risk. If you take, this is your unsystematic risk of portfolio. Very good question. Under variance, unsystematic risk under variance method. Okay. Next, you want to do what? Systematic risk of portfolio. Systematic risk of portfolio, very easy. Now only you just find out the beta of portfolio. What is beta of portfolio? 0.66. Point. Can you tell beta of portfolio? 0.66 square into variance of market 0.1 square. Variance of market. If you do this, can anyone tell what is the systematic risk of portfolio? 0.66 into 0.04. Small decimal will be there. Now you are getting your final answer. Portfolio variance. Portfolio variance. A portfolio variance, how you got it? Systematic risk plus unsystematic risk. Now, if they ask a standard deviation, they are not asking standard deviation. What you do? You take the square root. You take the square. If you take in percentage, this will be 13.57%. Like that. Are you able to get it? So this is how you have to make it. Are you understood? This will be 184%. So this is how a very good question, my dear friends. So you should be able to understand it very well. Yes or no? This is what we have did in the first method. How to do systematic risk and systematic. So what I'm telling is, when I'm doing this question in the regular class, I did similar model 2-3 questions. So you want to identify which one of the similar question and you have to practice it properly. Clear or not? It's a very good question. You have to understand. This is how we have told that how to find out under Sharpe index model. Are you clear? This you written the formula. This is a very good example for you to revise. Very good example for you to revise. We did few more questions also. Yes or no, friends? Yes. In the drive, we have added, if you are old batch students, in the drive we have added few more additional questions recently. You can go through in portfolio management. We are added it few more additional questions recently in the drive, so you can able to go through that also in the drive. Okay. Now on this concept. Now going further, we have last one method called a modern portfolio theory by what? Markowitz. So, my dear friends, if this is the modern portfolio under Markowitz, our normal big formula only. But in exam, you have to do in a table method. Exam, you have to do in a table method. I hope you can able to recall. We written like this: weight of A, weight of B, weight of C, weight of A. So now, how you go weight of A, weight of B, weight of C. Correct? Are you able to recall? How you will do, my dear friends? You might have been done this. You have to go for here weight of A, weight of A. Both are together. So your formula will be what? Weight of A into weight of A into weight of A. So you will take what? Covariance. You taken what? Do you have the table, my dear friends? Will you make it? That is standard deviation of A, standard deviation of B, standard deviation of C. How you written? I have that pen. Same thing. Weight only, na? Correct? Now you have to take it. There are three areas. Let me highlight it. Here, here, here. What is speciality there? Both are shortcut. I am telling. Both are what? Variance. So in this column, your formula will be weight of A into standard deviation of A whole square. But when it come here, what you have to do? Weight of A into weight of B into covariance of AB you have to. This is the only point. Correct? Yes. Next, what you have to do for this area, friends? Weight of A into weight of C into covariance AC. This is how you have to approach. Am I correct, friends? So if it is same area, if this area, how you will do? Weight of B into weight of B into there is no covariance. Right? There is no covariance. Both are same. So there is no point of what covariance. If you do this, you will get the final answer. I hope you have did this. Correct? In your book, that you have already done this. Shortcut only, I have just told you. This is if they ask this question, then you have to do like this only. So we'll continue the discussion. So this is however very standard question. We have similar few more question like that. So this is an example for what? Our CML method. This is an example for what? CML method. What is the CML method? A portfolio fully diversified. See the point? Fully diversified. Standard deviation 6, Nifty is 16.5. Ascertain the expected return. See here RF is not given. 5.8 100 is selling at what? 116. So how you do this? One part alone we will discuss now. Here you want to do first RF. How to do RF, friends? 100 rupees 5.8. Your interest is 5.8. But trading value is 116. So your RF will change. Yes or no, friends? 5.8 by 116 into 100. We will get an answer called what? 5%. We'll get an answer called what? 5%. Now you have to go for lambda. What is the lambda formula? RM minus RF. What is RM, friends? RM is Nifty, which is 16.5. RF, just now we find out by standard deviation. So RM is 16.5, 5 divided by 4. You will get lambda. What is the lambda? 2.87. Now you can go for the answer directly. What is the return under CML, friends? RF plus lambda, which is what? 2.875 or 87? 2.875 into for that particular standard deviation. The portfolio has a standard deviation of what? 6. So you have to multiply. You will get the return under CML. The same way only remaining thing. These are all are CML only. 31. They are asking to find out what? Lambda. So the same method of lambda application only in all the case. 31 is lambda. These are all same method. These are all basic question. How to compute the beta. See, these are all we discussed now. Beta, characteristics rate, systematic. So these are all one standard question we do. We are able to see. We discuss correlation coefficient beta, total risk and systematic risk. So all we discussed the method. See, this weightage also we discussed. Now going further, these are all the same point only. So these are all method we have discussed here. Here we have to find out the return on the basis of return, which is getting higher the return the stage, lower the risk is. This is a normal problem. Find out the expected return. Here return is given. They are not given the weight, the amount only given. So you have to take the sum amount, then you have to convert it to weight. Then weight into return, then you can find out the expected return. It's a normal question only. If you revise, you will be able to get it. Again, here comes the next question. They were asking what is the expected return. Same model question only. Now, they're all same. Here they are asking beta, same model only. Now here onwards, they were asking that that our intrinsic value concept. They were giving standard deviation is 5A, correlation is 0.8A, market standard deviation is 0.4. These are all relevant for 2-mark question. Return of government 5.2, market is 5.2. They want to know what is the return. So for the return, you have to approach CAPM method. For CAPM, you should find out beta. Beta is not given. You have to find out the beta. How you have to find out the beta? Standard deviation of 5 is given for the stock. Standard deviation of market is 4. Correlation is what? 0.8. So beta, what is the formula? Standard deviation of stock divided by standard deviation of market into correlation. You'll get the beta. Once you get the beta, RF is given in the question 5.2. Beta you find out RM is 9.2. You will get the return under CAPM. That's all. This already we discussed the beta characteristics line concept. Yes or no, friends? Going further, these are also we discussed beta, characteristic, systematic risk, and this floating and all will not come for your exam. Graph paper and all they won't give you. Here also the same thing, expected return, systematic risk. Here come the point. See whether the stock is underpriced or overpriced. This is only we discuss the point arbitrage. So for this, what you have to know 62. If you have the notebook, you can also take it. See the point is what you have to first to find out the beta. First you have to find out the beta. Once you find out the beta, see they given RF is what 6.5. They given RF is what 6.5. This is the market. So market into probability will get return of market. Market into, so if you want, I will do this final answer around 62. How can you go for 62, friends? If you go for 62, return of x, if you do x alone, return of x is what? 0.46 into 0.32, 0.38 into 0.26, 0.25 into 0.24, 0.15 into 0.18. What you will get, friends? What you will get it? Already you have the answer now. 62. Can anyone tell me? I just want to tell the final analysis. What is the answer? What happened here? 62. Don't you have the answer? What is the return of x? 33.33% is the return of x. Return of market also we have to find out how. 0.25 into 0.32. 0.25 means 25. 0.18 means 18. So 18 into 0.26, 11 into 0.24. What you will get return of market? 16.67. 16.5. 16.5% is the return of market. Now, RF is given in the question. What is RF? 6.5. Let me check whether your answer is correct. 25 into 0.32 plus 18 into 0.26 plus 11 into 0.24 plus 7 into 0.18. Correct. I was just testing whether it is correct. 16.58. Because when your analysis should not get wrong. So you get RF is what? 6.5. Now you have to find out beta. Beta they are not given. You have the data. You have to find out what your covariance by market. Accordingly, you will get beta of x as what? 1.67. You will get beta as what? 1 point. Small decimal correction may be there. So this you know. We are discussing this already. We know how to find out this. We revised today also. My point is what? Arbitrage discussion only we are doing it. How can you do? First one you have to do CAPM return. How can you do? RF plus beta of RM minus RF. So if you do this, you will get one return under CAPM. What you are getting, friends? 23.33%. See what is the return for the security? Return for X 33.33. See for the risk A, you should get minimum 23.33. You are getting is what? 33.33. Super. So the comment is what? Undervalued. Your action is what? Buy the stock. Your answer is what? Buy the stock. Same way you have to do for next one also. Next one, you will get a CAPM return of what? What is the answer? 20.31. The return of Y will be what? 22.56. Here also undervalued. Here also it will come what? Undervalued. This is how you have to approach. Hope you are clear. Yes or no, friends? Now moving further, this is also the same point we discussed today morning. Covariance, the same approach. Yes. Here comes the normal covariance correlation. Yes. Here they are asking variance into systematic and unsystematic, our normal. See, this is comes another method of what? Another method of what? Our Sharpe index model. Unsystematic is given, systematic is given, alpha is given. So unsystematic, systematic, if you get total, you will get total. From total, if you go for alpha, you can get what is the return of the security, reverse model questions. Here comes next. This is a 67. Again, the same model question they were asking. What is the standard deviation? What is the constitute a portfolio? What is standard deviation? Here also, you want to do which method, my dear friends? Sharpe index model. That is, you have to go reverse way. Question is given unsystematic risk. Can you just go through the 67 answer, friends? The question is given unsystematic risk. So you have to go for what? Systematic risk you have to find out. So unsystematic risk you find out, systematic risk you find out. Both you take total, you will get what? Risk of security. They are asking portfolio stuff. They are asking non-systematic risk of portfolio. So here also you have to approach the same formula. Which formula, friends? Unsystematic, systematic method, residual method. Clear? So these are all comes under our normal method of what? This intensity. These are all 2-mark model which we have discussed already respectively. This is another one question. What is a short-term portfolio? Short-term portfolio is nothing but beta. We have to find out the beta. Whether you change or not, this is the return of stock. Now you have to find out CAPM. Then you have to compare. What is your return? What is CAPM return? If actual return is higher than the CAPM, undervalued buy. If actual return is less than CAPM, overvalued sell. These are all that model question only. But it is given in a essay model question. Here comes the normal. Here you have to find the return here and all normal way CML curve and these are all 2-mark question. These are all 2-mark question. Here and all equilibrium return. What is equilibrium return? Equilibrium return is what? CAPM return. You have to apply reverse way. You have to find out the beta. Once you get the beta, you have to apply your variance model. So you can get the correlation coefficient. Accordingly, you will get the market return. So very very good question. But this is all we have to apply with our formulas. Here comes the concept of what? Our asset beta. Here comes your study material having only one question on this asset beta, but we taken separately in the part after the portfolio chapter. We taken separately asset beta problem, but your study material having only one question. They given what? We'll do this question alone asset beta. They given 40% and 60% unlevered beta. What is the unlevered beta? Equity beta. Unlevered beta is what? Equity beta is 0.9. So how you will get it, my dear friends? Tax rate is what? 0.3. So you have to find out your asset beta as your asset beta will be. The class I may be given this as a homework because we did lot of question on asset beta. So what is asset beta, friends? Your asset beta will be, you have equity beta is what? 0.9. So 0.9 into 0.9 into, you have to take the weight. Equity is what? 60. 60 divided by 60 plus, you should not take 40. You have to take tax effective. What is the tax, friends? 0.3 plus. See, actually here also there, but here the beta of debt is not given. Beta of debt is what? 0. 0, if you anything you multiply, the answer will be what? 0. So you don't want to go further there. So you will get here 0.9 into 60 by, what is the answer, friends? 40 into 0.3. If I am not, sorry, debt is 60. Okay, so equity only 40. So we have to correct, this is 40 and this 60, this 40. So you will get this 40. So 40. So you will get 82. Correct? 0.9 into 40 by 82. What will get the answer? Very good. 0.43. This is what? Asset beta. We have discussed different concepts. Once asset beta found, debt equity proportion changes, it will not have no impact. These are all normal portfolio question. Okay, these are all question. These are all intrinsic value. We'll do one question on. We did a undervalue, overvalue on the perspective of what? CAPM. This is another on the perspective of what? This is another on the perspective of what? Market price. See, they are telling that beta 1.4, companies maintaining 8% growth rate, last dividend is 4, rate of return is 12, 18%, current market price is, what is the equilibrium price? We will discuss this equilibrium price formula is what? Intrinsic value is equal to D1. What is the D1? The last dividend is 4 rupee, growth is 8%. So 4 into 1.08 divided by K. K we have to find out a CAPM method. What is the CAPM method? K RF plus, hope all of you are on track. RF plus, one second. RF plus, what is the RF? 12. Beta, what is the beta, friends? 1.4. What is the RM? 18 minus 12. Tell my dear friends, what will be the KE? You will get it. We'll do one intrinsic value. We want to do all the method, one at least one question. So what will be the KE, friends? 20.4. You will get the KE as what? 20.4. So you will make it here 0.240 minus growth rate 0.08. You will get an intrinsic value. What is the answer, friends? 34.38. This is your intrinsic value. Market price selling right now is 32. That is given in the question. Yes or no? Market price right now selling is what? 32. So if you right now market price selling is 32, tell my dear friends, undervalue or overvalue, your intrinsic value can go for up to 34, but market is only 32, so it is called undervalue. If it is undervalued, what you will do? You will buy. Are you clear, friends? So this is how the method of what? On the base of shares. See, this question number 85 also on the base of share only. Question number 85 also, see, they are telling buy, hold or sell. When you will do hold, my dear friends, equal. That I forgot to tell. Undervalue, overvalue at all. If both are same, it is called correctly priced. Then you will do what? Hold. See, this question again, it comes CAPM point. You want to find out what? Beta of equity, then you have to find out what is the CAPM return, what is the actual return, just like our previous question. We did one question here the same way. This question here we did this question, CAPM return the same way we have to do this question, correct? So if you gone through here, these are all the same. This is all comes under what? Reverse calculation. What is the return? Actual return minus CAPM return you have to compare. These are all three cases are there, M and O. Each case you have to do what? Actual return minus CAPM. Then you have to give undervalued or overvalued. So these are all the same point. Here comes from question number, if I'm not wrong, question number 91 onwards. Here come the APT model. What is APT model? Arbitrage pricing model. In your 22 syllabus study material, it's a separate chapter. So that it can come one question separately also. Last exam, one question came from RPT model. So this 91 is onwards RPT only, direct formula. RPT model is a direct formula. What is the direct formula? RF plus beta factor 1 into sensitivity. Beta factor 1 according to your group. So from 91 onwards, this is just now telling the revision time. 91 onwards, these all are RPT in your study material, separate chapter. So this all comes under RPT that end with what? That end with a question number 94. So the 94. So you can just revise that little bit, because if they ask separately one question, because two questions will come from portfolio. So one, if they ask from RPT, that last exam trend continue, any one question from there it will come. Last exam, the question they came, it is what I told you. Now these are all additional question. You have already written, it's a separate question model. Okay. Last exam, this is all this question on asset pricing. See, in last exam, this is a RPT model. This is also RPT. 103 is a RPT model question. Then 104 is a RPT model question. This 105 1 very good question. You have to do two formula. Accordingly, you solve it. It's all not a new concept. They were asking equilibrium return is what? Simply, what is the RM and RF? That's all we revise. That's not a new concept at all. This 107. Last exam in RPT model, they came. The exam is what? 107. So this is how you have to understand, my dear friends. So if you go through, first we started discussing with what? First we started discussing with what? Unique model question. What do you discuss? Unique model. Do you able to recall the unique model? We can 4 question number. What was the question number, friends? What was the question number? 4, 3, 14, 40, 98. These are all unique models. So that once is over, then you have all the concepts we release in there. See, now what I have to tell you that we did all the method at least one question. We revised all the formula. If you go through your formula, all the formula we did application. That for you to revise and understand very well. Now, what we are going to do is we are going to go with your MTP now. Now, if I go through MTP itself, you will tell me whether I have to do or not. That is what speciality of MTP. This MTP, see, let me tell you one main point. Current MTP, you just easy questions only, but you practice better, because the first exam of 22 syllabus, MTP around 24 for in this SFM, they came close to 25 questions. Some network issue. Now, my dear friends, I will tell you separate strategy for 2 mark. So now, as I told already, I told the same question only will come for 2 mark also. See, if you go to question covariance, 2 mark. Covariance is given, market is given, what is the beta of stock? Like that direct. When you do the essay, you can able to do the 2 mark as far as this chapter is concerned. Then I have told you, see this, the certain mutual fund, standard deviation, that is mutual fund related only. Portfolio. This is the first question on portfolio. The covariance of the stock market return, we have to find out the beta. Directly we can approach. Type of risk, we told theory purpose they will ask. Portfolio, systematic risk, like that. 2 questions they came from what? Portfolio management. Only 2 questions they came from what? MCQ. Now coming for what? Our MTP. We are looking now MTP only of what? We are looking now MTP only of what? Our portfolio right now. In this session, we are doing only portfolio right now. So if I am going through portfolio, let's see. You taken with the answer, that is the way it is getting more data. We need only questions. This mutual fund. See, you will wonder now, the first question, MN, we discussed this question today. Yes or no? See, our strategy today is what? One second. Yes. So where we are right now? This question we discussed today or not? We discussed old MNA, you take 20%. Risk will be what? 60. The same question only came, which we discussed today. Am I right? So what we are focused in the revision session, the same question only came. Now will we go for A? See, from the following information, ascertain market price of risk index. Are we revised this question today? I told market price is nothing but lambda. Just 5 minutes before, if you just back the video, you will able to find this question. This is on the base of this 5A on the base of what? CML return. 5A on the base of what? CML return. So you have to find out first CML. What is CML formula? RM minus RF. So 18 minus 16 divided by 6. You will get lambda. Then you have to approach the formula. RF is 6, lambda into this portfolio. Correct or not? So this 5A, 5B, both we discussed it today. Same ditto question only, but exam it won't be ditto. That is different perspective. Okay. So this is the answer. So two questions. That is 7 into 7. Sorry. Here, next day, see, we discussed another portfolio question. This is not portfolio. This is from uh, forward. So we don't want to go for forward now. So two question came from forward. Two question came from no, sorry. Two question came from where? Portfolio 7 and 7. What is the mark? 14. Every exam this 14 mark minimum will come. 14 plus 2 mark MCQ. So 18 mark. So close to 20 mark it will come. So my dear friends, this are you clear? Yes or no? So MTP also we completed. Now, as I told when you doing the question, I told you 2-3 questions. Recent previous year question. Recent previous year, I can't take the issue website, some error is there. So recent previous year question also we discuss in what? Portfolio chapter. So that is why portfolio all the area we were covered. So what our approach today is, we are winding up today. We are winding up today. We will continue tomorrow with mutual fund. We will continue tomorrow with what? Mutual fund. You requested me 2 areas, portfolio and mutual fund. So tomorrow we will go